For decades, the U.S. stock market has enjoyed a long-term boom under the protective shield of the Federal Reserve. Since the 1980s, the Federal Reserve System has been the savior of the capital market whenever the stock market was in crisis. When the stock index plummeted excessively and the downward trend deepened, interest rates were cut and the money supply was increased to protect investors from large losses. The Federal Reserve's role in preventing losses in a falling market has a similar effect to a put option. A put option guarantees the holders the ability to sell a stock at a specific price. Therefore, even if the stock price falls below the price, the investor will avoid the loss. The same went for the Federal Reserve. When stock prices fell beyond a certain level, they intervened in the market. This kind of Fed put began 25 years ago with the long-term capital management incident. This market defense function of the Federal Reserve is called the Fed put. The function of the Fed put was most notable in March 2020. As the coronavirus spreads around the world, the stock market fell into panic. As the stock index fell more than 30% in just 1 month, fears like those of the Great Depression spread among the investors. Then, the Federal Reserve held two emergency meetings on March 3rd and 15th and lowered the policy interest rates from over 1.5% to close to 0%. The effect was great. In August of that year, the stock index exceeded its previous high and rose 40% more than its previous high by the end of last year. The market calls this the Powell put, named after Federal Reserve Chairman Jerome Powell. Fed put is a compound word of Fed and put options. Investors' expectations are that the Federal Reserve will provide a safety net, such as put options, when stock prices are expected to fall. The term Fed put has never been mentioned as an official policy of the Federal Reserve. However, if the stock market fell by 10%, there was an average future interest rate cut of 32 BP. The long-term capital management was founded in the early 1990s by John Merriweather, a famous bond trader at Salomon Brothers. He invented the Black-Scholes model, a formula for calculating option value, and prominent scholars such as Professor Martin Scholes, an economist who even won the Nobel Prize in Economics joined him as partners. High profits were made through interest rate arbitrage investment, such as buying government bond futures of countries with high interest rates and short selling government bond futures of countries with low interest rates. However, LTCM suffered huge losses when Russia, which had made large investments, declared a moratorium in 1998 and eventually went bankrupt. In 1998, LTCM was a bomb that would blow up the entire U.S. financial market. The solution that emerged at this time is the Fed put. The Fed put was also applied to the dot-com bubble in 2000s, the collapse of the Lehman Brothers in 2008, and the subprime mortgage crisis. Quantitative easing and the zero interest rates policy introduced during the coronavirus can also be said to be an advanced form of the Federal Reserve put. The principle of the Fed put is the same as investing in a put option in preparation for a sharp decline in stock prices. The Federal Reserve suddenly rose interest rates, giving market participants the same effect as investing in put options. On September 23, 1998, the Federal Reserve Bank of New York held a meeting with major Wall Street investment banks. LTCM received a $3.5 billion bailout on this day. On September 29, 1998, the Federal Reserve held an emergency meeting and lowered the interest rates from 5.5% to 5.25%. Since then, interest rates have been cut 2 more times. Wall Street investors, reassured by the strong interest rate cuts, began buying stocks. The S&P 500, which fell below the 1,000-point line, rose to 1,463 points a year later. The Fed put is an anomaly that does not exist in orthodox monetary policy. In principle, the central bank does not directly regulate asset prices, such as stocks and real estate. However, the Fed put violated that principle. The Federal Reserve uses regularly in crisis situations. It is a kind of stopgap measures.